Wow, so I definitely was not on the wrong track yesterday when I talked about the possibility that, this whole Wu flu thing of the coronavirus outbreak could be triggering the next financial crisis, which, of course, people like me have been waiting for. Because the seeds have been sown for quite some time that the next time that there is any decent pullback in the economy, that there is any cooling off period of economic growth and of growth in equity prices, that we're going to have a pretty serious collapse because we've got a very very unstable foundation that this whole economy is built on. And of course, there's been a lot of volatility in the stock market, but today, and I know I made a video last week talking about, hey, you can't just look at the day-to-day moves in the stock market and try to analyze every little thing and try and justify why it went up or down on a given day. But today was so dare I say apocalyptic, violent, that it deserves special attention because we opened this morning limit down. And for those of you who don't know, it's been it's very few times in history that the stock market has moved limit down. What that means is that the stock market this morning, within about a minute and a half of opening, fell so fast, so far, that the New York Stock Exchange has safeguards built in to stop people from selling, and they closed the markets for 15 minutes today. And the reason for this is to prevent people from selling off too much because, of course, they never have limit ups. If the market came in and rose 7% like it, instead of falling 7%, they wouldn't close the markets. They want people to buy as much as possible. But they never want people to sell stocks. Nobody ever wants stocks to go down. Everyone just wants the stocks to keep on rising and rising forever, even though, we are so overextended. If you look at, market cap to GDP, stocks are way overvalued. Any monkey could tell you that. It's a very simple graph to look at market cap to GDP, where it's been historically and where it is right now. We were at 158% at the peak. We're still well over 100%. And so stocks have plenty of room to fall, in the meantime, before they get to a more realistic valuation. Yet we have, because the market today fell 7% at the open, it closed for 15 minutes. We opened back up, and there was that was a cooling off period for investors. Folks were supposed to be sitting in the naughty corner, taking some time. The shorts were put in the corner, and they were told, hey, you short sellers, think about what you've done. And when they came out of the corner, they said, you know what, I did something bad, and so I'm going to go back and I'm going to buy stocks now. And so there was I wouldn't say, it's hard to call it a rally because we were still so far from green, but there was a ramp, I guess. You know what, I'll call it a rally. There was a big rally. We had a huge rally, like into the range of, I think, back less than 5% down. So in the fours, we went from being 7% down to being, only less than 5% down. So a sizable move upwards that did not hold. It was a rally that was sold intraday, suggesting that once they broke that limit and you had that limit put into effect with that break in trading, that was not enough to really restart buying, to reinvigorate sentiment. And what that means is that this is a very serious move down. And the reason for this is, there's more bad news today, even though it's pretty good news for consumers, other than just the Wu flu. And that, of course, is this huge fight between the OPEC countries, plus Russia, that broke out, to where Russia and Saudi Arabia essentially are getting in a slap fight. They're not going to agree to try and stifle production of oil. They're going to keep pumping. And so this is pushing the oil price way down, which is great. If you're someone whose business, relies on using fuel, or if you're just an ordinary person with a car, gas is going to get cheaper. That's great news. But this is very bad for the financial system, as there are a lot of oil companies which are essentially zombie corporations. These are companies that only really exist because the Fed has provided so much liquidity to the market, to where companies that are really on a bad footing have been able to get credit and have been able to sustain their operations, even though they're not making money because oil was too cheap to begin with. Especially in North America, a lot of these oil companies are only able to operate when oil is sufficiently expensive, because it costs them so much more to extract and process their oil than it does take the Saudis. There are different oil is not as simple as just drilling a hole in the ground and having oil pop out. But there's different ways of extracting it. You've got fracking and shale and all this sorts of different stuff, and a lot of these guys have very high costs, not only labor costs, but just the method that they use to get the oil out of the ground is not very efficient. And, despite that, they've been able to get credit, and there have been banks that have been lending to them. There are lots of people who have invested and bought their bonds. Apparently, the energy sector makes up about 12% of all junk bonds in America, and that's not counting all of the BBB rated bonds that are probably going to be downgraded because the oil price has fallen so much that the ability of those companies to pay their bonds has been diminished, and so therefore the ratings agencies will downgrade their bonds to junk status, meaning that they are very high risk and they're going to have to pay a much higher interest rate, which means that a lot of these companies are going to go bankrupt. That is a reality right now. And so while it is, like I said, good for consumers that oil is down and the gas is going to be cheaper, it's very bad for Wall Street and the financial system that a lot of these companies are going to go bankrupt. Because if you were dumb enough to expose your balance sheet to all of these companies that frankly the average analysts were predicting were in big trouble, well then you're kind of screwed. You don't want to own those bonds. But unfortunately, even if it doesn't affect you, because the system is so intertwined, because this is how finance works, it affects you even if you're not directly exposed. And so this, along with the Wu flu concerns, managed to bring the market down today even more. And that is, probably why it was so violent today. Now, the oil thing, here's the thing with the oil thing versus the virus. The oil problem, if you want to call it that, can be resolved at any time if Russia and Saudi Arabia come to an agreement and they raise the price of oil. Which, again, I don't really want the price of oil to go up. I don't think that we all should have to suffer just because some people bought some bad bonds. But, if we're talking about avoiding the financial crisis, that's one thing that would have to happen. Because that just adds so much stress on top of the supply chain constrictions that we're already feeling. But putting the topic of oil to rest for a while, if you look at today's decline in terms of percentage points for the S&P 500 is the 17th largest point decline in history, and all the other declines either other than 1987, which was the one that was the biggest in history. That was a 20% down day. That was a one-day bear market. 1987 is legendary for that. And that, of course, was so-called remedied by Alan Greenspan. But anyway, if you leave 1987 apart, 1987 is an anomaly. The only precedent for this, the only days that were worse than today for the stock market occurred, around the 2008 recession and that whole financial crisis, and also from the Great Depression. Those are the dates that we're talking about that are relative to today. Okay, we were down over 7%, even after, I don't know if I mentioned this, but after the limit down at 7% triggered the 15-minute suspension closing of the markets, which is, quite an extreme measure. Even after it opened back up, they could not sustain any levels above that. They ended up closing again below that 7% threshold. And so this all is doing tremendous sentiment or damage to the sentiment in the market, not just in the stock market, but people operating the ordinary economy. People, I was talking to a waiter today at lunch, and he was telling me how since not only with the coronavirus thing, but with the declines in the stock market, he's been seeing such a drop off in traffic in his business. Because people not only are concerned about getting sick, which is a very big thing. I was at happened to be at a shopping mall today, massive shopping mall, usually lots of people there, always packed, tough to find a parking space. Found a parking space right where I needed to go, no problems at all. Probably because people are concerned about this virus and they're self-isolating. They don't want to be in places with lots of people, crawling around in a shopping mall. Also at lunch, people, in restaurants, they don't want to get sick, and also they don't want to be spending so much money eating out when, their 401k is down 15%. Because they have to tighten their belt. If they're already retired and they're living off, now they suddenly have a lot less, money stored away. And if they're not retired yet, well, now they have to save more to make sure that they're going to be able to retire someday, which, frankly, I don't know if that's realistic. I've said in the past, retirement is a thing of the past. I've been saying that for a while. I think that that's true. I'm not the only person saying that. Now, how quickly retirement is going to disappear, I don't know. But I know that my generation, there's going to be very, very few people who are going to be able to retire. Now, always, the uber rich are going to be able to retire. But ordinary people, I don't think that's going to, stay in place. And folks are realizing that. So this is having an effect on the real economy already. It's having an effect on the sentiment of consumers. And today, as people get home and they watch the evening news and they see that the stock market is down, over 7%, people are going to get scared. With all this coronavirus stuff going around, with the oil crisis. Now, the oil prices thing is going to make people feel kind of good, but I don't think that it's going to outweigh all this. The benefit to the economy of having lower oil prices, it does not outweigh the damage to it done by the decline in the stock market. So therefore, the decline in oil prices is a net negative for the economy at this point. And so when we get into this point to where people are losing their optimism, to where things look like they're going to keep going down with no end in sight, it becomes very difficult for the Fed, who is really the only guys waiting in the wings to do anything about this. Those are the only folks who can put a stop to all this. It's not going to be the CDC. The CDC is totally incompetent. The only folks who are going to do anything to try and quote unquote save this economy is the Federal Reserve, and the only tool they have in their toolbox, so to speak, to use their language, is printing money. That's all they can do. They can inject liquidity. They can bail out Wall Street. And as I've been saying, is that going to be enough? I don't know. But that's all they can do at this point. I think personally that the Fed could go out tomorrow and just buy up all the bonds that are going, rolling over, that are going to be defaulted on, to make sure that none of these companies go bankrupt. And I don't think that necessarily is going to change the sentiment in the real economy. People are still going to be scared about everything that's going on, even if the Fed can somehow, stop these companies from going bankrupt. They're not going to be able to convince folks to go and buy stocks. The Fed just doesn't have enough ammunition for that. What they do have, I guess they can do negative rates. And QE infinity. These are very extreme things. These are not signs of a healthy economy. To me, if you're looking at the threat of the Wu flu here, and you're looking at how far the stock market's already fallen, I think that what the Fed can do at this point looks pretty weak. It's not like in 2008 to where QE was something that had never been tried, to where rates had never gone down to zero before. These were novel things. They seemed very extreme, and they were potent, and people bought into it. And people felt like the Fed was in control. The Fed seemed like they were acting professionally. The Fed does not seem that way this time around, and the sentiment, I can't overstate this, is more important than anything. Sentiment is what drives markets. Markets, and prices. These are all subjective things. Economics is not a natural science. It's a social science. You have to study the human element here. You have to look at how people are responding in their own lives. Your silly little equations cannot predict, what the impact policies are going to have. That's not, it's not a mechanical relationship. And so as Sven Henrich has been saying for a while, the efficacy of monetary policy has been greatly eroded in recent times. The central banks, I do believe, are, pretty much out of ammunition. And at this point, I don't see how they're going to convince ordinary people, the actors in this economy, that all is well, and to convince them to go out and to try and, live like they always have, with excessive debt. And with spending profligately and never saving any money. Bill Mitchell's been saying to buy the dip. Bill Mitchell, of course, the chief Trump apologist. I said, I've been saying for a while, Trump's very dumb for taking credit for this bubble. He said it was a bubble when he was running. He knew it was a bubble, and then as soon as he got elected, he took credit for the bubble. And so, if he loses because of this, it's entirely his fault. But despite all of the Trumpists going out and saying you should buy the dip. And Bill Mitchell still trotting all that out, trying to be a bull, the last bull standing, I guess you could say. Futures opened, just a few minutes ago as of recording this, and we're down still. I think on the headline I saw, of course, quoted the Dow. It said like 200 points, which I don't know how many in the S&P, maybe 18 points, something like that. Anyway, still, nobody's buying the dip here. And you have to keep in mind that the lower we get, the more margin calls there can be, because we have such a heavily levered equity market right now. People can't sustain these losses. Selling begets more selling, because as some people sell, the folks who are levered get margin calls, and they have to sell their stock to because they have to pay back their creditors, the people who loaned them essentially the credit to go out and buy more stocks than they could actually afford. So I would say that things are far from over at this point. I don't know when necessarily we've reached a point of no return. I would never say we're at a point of no return. I just don't see a bottom at this point. I was cautious over the last couple weeks as the selling was picking up. I was saying, hey, there's room for rallies up here. There is the potential that people are going to buy the dip, and save this. It's not necessarily the end. You never know it's the end until the end actually comes. And so I'm not, even at this point, I won't say that this is the end. But it is very hard to avoid the reality, I think, at this point, that the cycle is turning. And that, the so-called prosperity that we all know and love in this country is not going to last through November, through the election. But I've gone too long. I don't really want to get into the political ramifications at this point. I think we'll do that later when the future is more certain. So if you get anything of value out of this video, I'd appreciate you clicking that like button and sharing this video. And if you haven't already, please do subscribe, because I do upload every day, and I'd hate to have you miss one. So I'll see you folks back here tomorrow.